Okay, welcome back here, smarthelping.com. I just uploaded this video last night and realized I had the sound off, so I'm redoing the video. Sorry about that. So what I've got here is a three-statement financial model, fully functional, fully interconnected. It goes out for up to 5 years, and it shows a monthly and an annual summary. All the labels on the income statement or all the financial statements are automated based on what's on the um, control tab for like the date and the months that your forecast includes. You can stop it at any point. Say you only wanted to do 3 year, you can easily stop it there and do that, and you can see everything that's relevant. All the main line items will blank out until that end of that year. Now you also note that, um, well, we'll get into it in a second. So let's finish the control tab. So you've got your start year, you enter the start and end date of the operations, tax rates, capital gains tax rates, min-max cash positions. Obviously, you can't have a negative cash position, or else that means you've run out of cash in your forecast. You can pay dividends or not, which just is going to define how the equity either accrues to the shareholders on their accounts or it is paid out in dividends, which is cash out. Uh, and you can see total dividends paid here and retained earnings and equity balances. And so let's get into this. Now, my goal here was to make a really general use model where you could just drop in um, a template. Like if you bought a forecast but it doesn't have a three-statement financial model, you can easily drop the data in on a monthly basis. So most of your data entry is going to happen on the income statement. You have four types of income here. You can paste it or paste it in. Um, Cost of goods sold, operating expenses, and then you've got EBITDA, interest, which interest is going to be automated from the debt schedule, and you can put the amount of debt you want, the terms on it, the payment date, and the payoff month. Now, obviously, if you plan to just do a forecast and not exit the business and just do the forecast for over the first 3 years or whatever um, you're doing, you can just hit NA, and it won't do any payoff. But if you do click one of these, it's going to pay it off. You can see September 23rd, it's going to pay that off on that month. And you'll see the capital fluctuations happen in the cash flow statement from that. And you're going to want to make sure, let's say we're ending it on December 22nd, then this, to make sure it captures it, you want this to be December 22nd as well. Okay, so then the interest will populate from that schedule automatically. You've got depreciation. So depreciation from our CapEx schedule is based on long-term fixed assets. The first row here is always for the building, because we're going to take account of the value of that sale if you do plan on selling at the end, um, separately from the value of these other fixed assets. So you enter in their cost basis, useful life. It gives you the monthly depreciation. It's all straight line based. You can pick the month that you actually plan on buying the given item, and then based on the useful life, you'll get the end of depreciation, and it knows based on the end of the model which comes first, the end of the model or the depreciation, so it knows if it should be zeroed out for the book value at the sale month. If not, um, we're actually going to define the valuation here based on a multiple of revenue, and then you're going to have some of that applied to just extraordinary revenue, which is like if you sell a business and the value of the business is X, not counting the value of the fixed assets. So we're assuming some percentage of this value is going to go to fixed assets. So here we're saying 90% is going to extraordinary income, which is taxed differently again than capital gains. This amount 150 is going to go to the value here. So you can see if I just sum this up, it's going to be 150,022, which is this number. and that's split proportionally to the book value at the end of the sale month, whatever that might be, and that's all automated based on what you pick in the front end of the model. And then the value of the sale of the building is going to be separately input, and this should be the net amount that you get after all selling expenses. Then you've got gains and losses, which these are all long-term capital gains right here, so that's going to be taxed at a less percentage, which you can define on the control tab. And then the other amount, this amount, which is extraordinary income, is just flows right to net income, taxable income at whatever corporate tax rate. So there's some things you can do there. That's pretty nice. Let's see. And then obviously accumulated depreciation is going to be part of a balance sheet item. But let's get back here. So that's how depreciation schedule is updating. Then we've got um, the extraordinary income, which will automatically come in on the whatever month is the month of the sale. And then the net gain loss from assets. So these are all used to figure out what the net income is or what the taxable income is. And then you've got your income tax capital gains, which it's basically amortizing the taxes over 12 months based on if the value for the year is positive. And there's things to check how many months are actually active for a given year to figure that out. In case you end the model halfway through a year, then it's only going to count 6 months instead of 12 to accurately get the monthly amount. And then you can see this 185 is higher because we're doing 10% of our net gain loss from the sale of the asset. So then we get to net income. So this is what we're going to use to define how much any shareholders get, if any. So you can see here there's an investor schedule. You can put in the amount that they fund, the months they fund, the valuation at which they do fund, and that will define how much equity share they get. And anything left over obviously flows to retained earnings. There's equity multiple here. And so if we go to our income statement annual, it's the same thing as the monthly we just went over. It's just on an annual basis, but same exact thing. That will always tie out the net income here. You can see 4,542,000. That's 4,542,000 here, so those always match. The monthly balance sheet is now you can see here on the sale of the business. We're assuming there is a sale, so we're zeroing out all fixed non-current assets. They're getting sold. That's going to show up in your cash, and we're zeroing out accumulated depreciation, and then paying off the debt. So this is really showing you a snapshot of what actually happened after you sell and where the money is. Um, Equity for the investors, and then the retained earnings of the company, which is only kept by the owners or owner. And obviously liabilities and equity have to equal your total assets. And we've got a check down here to make sure. Now the annual balance sheet does the same exact thing again here. Now what I've done, if you don't want to plan for a sale, you can easily zero out this multiple here, and it'll say there's no money for any of this stuff. And then you can see on the capex there's negatives here, but none of this is going to be relevant because there is no sale. So if we go over to the monthly balance sheet, you can see now, um, and if we did that, no sale, we're going to say we're not paying off the debt. So there's still debt here. Um, you've still got all your fixed assets, accumulated depreciation, and everything is just as if you're not selling, you're just ending the model at that month, but it's not like an exit. So I think that was really helpful to have the option to have an exit or not an exit of the business. And you can see here there's no effect of the sale of the business or net gain or loss because those are all zeroed out. Based on everything is really contingent on this multiple. If you put this at zero, basically that tells the model there's no sale happening. So no effects here, no effects on this. This could be zeroed out too. None of this will matter here on the net gain or loss. Um, so let me undo that for the purpose of the model. Okay. Next up is our cash flow statement. So this is using the direct method of accounting, and that means we're basically just looking at what we receive from our customers, what we're paying out for cost of goods sold, operations, interest, taxes, basically all the cash flow items that happen in a given month that affect cash. So you're not seeing depreciation in there, obviously. And then you've got cash flow from investing activities. So this is going to be your expenditures, the sale of the business is in here, sale of depreciable assets, cash flow from financing activities. Mainly, you've got borrowing long-term debt, principal repayments on that debt, any sale of company stock, which is we're saying is sales to investor or investors buying in, and then cash dividends paid. You got the net cash effects here and net change in cash, and this will obviously define. You see 7 million to let's just sum it up like this. So 7,271,000, which should equal your balance sheet ending balance 7,271,271,14, which it does there. Again on the monthly. So that's just taking that net effect of cash, the cash flow statement, plugging into the balance sheet. Now, the other interesting thing you can do here is you can actually choose for dividends to not be paid out. If you click no, you can see on the balance sheet at the end, um, common stock is rising. So that guy started at 5 million, now he's got 7,271,000 because that's the value of his share in the company has just increased his basically his common stock. Um, and the cash is higher now because that has to balance out, because if you didn't pay out those dividends, it adds to cash, but you owe more to the investor. And then retained earnings is not affected by this transaction at all, whether you pay dividends or you increase the common stock, it doesn't matter. And again, I've built this to try to fit 90% of cases. Obviously, there's probably a small 10% amount of cases that just it's not going to work. But this is for general purposes is going to be flexible enough to fit probably 90% of needs if you're trying to do a three-statement financial model for a business. Um, and I've really tried to make it as flexible as possible and as useful as possible for the most amount of people. I'm just going to extend this back out to 5 years here and change this back. I'm trying to think of anything else that you need to know about the model. I think that's pretty much it. You can do 7 different investors here. Now, if your cash goes negative, like if on your balance sheet your cash is negative at some point, that means you've run out of money in the forecast, and what between your capex, your operations, and borrowing, paying back debt, and everything else, you don't have enough cash you're just out of cash. So you'd have to either have more investors come in, or borrow more money, um, or change the forecast, or obviously it's showing you that there's just not going to be enough cash to do what you're trying to do. Um, Now, if you have inventory that's offset, like you purchase it every certain amount of months, you can manually enter that in for cost of goods sold. You can just put it in, like say you buy like 10 months worth of inventory in month one, you can just put that in here. That's why this is all data entry, so it does account for purchases. You can easily set that up here, no problem. The only thing I didn't include is accounts payable and receivable, because this is assuming everything is happening in the month, like cash receipts. There's not like a 2 month delay in receivables. That's a different use case, and I'm not modeling that here. It'll change the model too much and make it too difficult for other use cases. So let's see, anything else? I think that's about it. And again, if you want to purchase this, it's going to be a one-time fee of $45. You can buy it at smarthelping.com. I'm also going to list it at Eloquens and efinancialmodels.com. And again, I think it augments all the models I've already built, because you can fit this in with basically any of them. If you want a more formal set of reports that are universally used, this is what you can kind of bring bridge the gap between those and this. And I think this is super useful. All right, I'll see you on the next one.